Hey everyone, David Coe, the Co-Real Estate Group. I am a local realtor here in Redondo Beach, specializing in the South Bay area. And one of the questions we get asked all the time is, do I need to sell my existing house before buying my next house? So to kind of help me unpack that today, I brought on my good friend, James McKibben. James, thanks for joining me today.
Of course, thank you. Yeah, thanks for having me, guys. My name is James McKibben. I've been doing loans for about 20 years. I've seen this pop up a lot with, do I sell before I buy? So I'm excited to talk about that today. I specialize in creative financing, and so I'm really excited to tell you more about some of the wins that we can help you with as buyers out there in this market today. And so we'll talk about that in just a few minutes here.
Yeah, and one of the reasons I love working with you, James, is look, anyone can do the easy deals. It really takes a pro to do the hard deals. You and I literally just got a loan. Well, I won't say done. I don't want to jinx it, but we got someone pre-approved on the loan that had really bad credit, had some late mortgage payments, and you were still able to get them approved. So, I love the versatility that you have. And this particular question is one that's right in your wheelhouse, right? Like it is kind of an unstandard loan when someone's looking to purchase a home before they sell, right?
Absolutely. So I have about 85 different loan programs right now that I can utilize in this market. And I can tell you, oftentimes, only one program will work for a client. If we talk about someone buying before they sell, I've had clients actually say, we have to sell first. And they look at homes for 6 months making offers or a year. They can't get accepted because sellers they don't want to take a contingent offer. Too much can go wrong. And
Yeah,
so
let me jump on you real quick on the contingent part because I think that's the thing that most people don't understand, right? Like as a listing agent, if I have two offers come in, this one has 20% down and can close in 21 days, and this one has 20% down, but they have a 21-day contingency to sell their property. That means I am waiting as a realtor for that agent who might not even be the listing agent. They might have another listing agent to sell a property in an area that I may not know about. I may not understand if it was presented properly. I may not even know if it's priced properly. And therefore, I'll automatically discount that offer because there's too much unknown. And I've got an offer here that I actually understand what it is. So
absolutely.
I know that people like the idea of selling first, are selling their home first and then buying it. But when you're doing it and you're contingent, there's all kinds of complications. So today we're going to talk about ways to eliminate that complication. And there are loan programs that basically allow you to use the equity in your current home, buy your new home, and then sell the existing home off, which gives the seller a couple of things that are benefits. Number one, you only have to move once, right? So if you sell your house, you may have to pack up all your stuff, put it in storage, stay in a rental, stay with a friend, and then move again once you actually find your home. Versus if you can buy your home first, you can move out, then we can prep your home for sale and you don't have to live through open houses, emergency showings, and all the other things that are associated with that. So let's kind of jump into what are some of those loan programs. So I know the first one that we talked about was doing a bridge loan. Can you explain what that is and how it works?
Absolutely. So a bridge loan can be, it sounds hard, but it's really not. I'm going to simplify it for all the buyers out there. It's a great product and I'd love to customize it for anyone that has questions. But what it is the home you own, your departing home, we call it, your vacating home. We give you a loan on that property. We essentially bridge you over to the next property you're buying. So what we'll usually do is pay off any existing loan on that property, plus give you cash out. That cash out becomes your down payment for the home you're buying. What's great about a bridge loan is we don't hit you from a qualifying ratio standpoint on the home you're moving from. So you're
Mm.
only qualifying on the home you're buying. There's a
So their existing payments on their current mortgage won't get factored into the payments on the new mortgage they're going to take when they get on the bridge loan.
Exactly. And it's hard to qualify if you have two mortgages unless you have rental income offset. So it enables you to only have to qualify for the outlay property, if you will.
Right.
And there's also like a lot of products for bridge loans. We can do bank statement bridge loans. We can do non-qualifying bridge loans, full doc bridge loans. So if you are someone that says, hey, I'm self-employed, I write off all my income, that's probably okay. So we have several options, even within the bridge loan category. Most people only
have a bridge loan for like 1 to 4 months. So it's very short lived because then you sell your home, pay it off. So it's a pretty
There any
net.
kind of requirement that they have to sell under a certain time frame?
Most bridge loans are either some of them are 1 year or some are 5 years. Kind of have that range. But
Okay.
most people, if they've committed to doing a bridge loan, we're gonna find that sweet spot where they pay it off and we'll just get on the new property. And some people will say, well, how much do they cost? It's a great question. Let's just say a bridge loan, let's just use a round number. Say it costs $15,000. There's actual analytics and data that if you move from your house, you'll sell your home for more than 15,000 more.
Hmm.
So basically, well, with the sale, with your proceeds of sale, you'll make the money back for the cost. Because most people, when they live in a house, they have boxes, they have pets, they have things where it's not to everyone's standards. But you're kind of out of the way, you take care of that. Your home will sell for the data quicker and correctly. So kind of
And James, that's why we like that product as a realtor, because we can get people moved out and we can do a better job prepping their property. If someone's living in it, we really can't go in and paint it. We could, but it's harder to do that. So it's great when we can get an owner out, prep it. You're right. We can absolutely sell it for more money once they've moved out versus if they're still living in the home.
Well, for more than a bridge loan cost. There's actual data around it. So it's
Yeah.
a great comment, and we can customize it for everybody, whether they have low credit, and we can make it work for you. So
How much equity do they have to have in their home to be able to, get a bridge loan?
great question. We can generally go up to 75 to 80% of, so let's say that their home's worth $1 million with the home they're selling, go up to about a $750,000 to $800,000 loan. So if they owe 400,000 or 500,000, we basically pay that loan off and give them cash out, and then that's their down payment for the uplake property. So the value, I should say, the equity position can be important. But then we can even get into some more products, which we'll talk about in a second on this, that may even allow for more leverage on their vacated property.
Speaking of which, you mentioned leverage to leverage. What is that?
Yes, leverage to leverage means anyone that's created wealth in this country, they know how to leverage. So we can look at doing up to a 90 or 95% second mortgage, not a bridge loan, on their current property. You do either a line of credit or a fixed second. Some of this will depend on, do they qualify for both properties? Sometimes we can also get a little bit creative because we have products that also allow to exclude the payment on the vacating home without that home being listed with even just a simple letter of explanation. So if you look at Fannie Mae and Freddie Mac, the two largest secondary market investors of home loans, that they buy about 95% of loans on the secondary market, they don't even allow the exclusion of the loan on the property they're selling, but other products do. Well, if we get a letter of explanation that says that the seller will sell within 90 days, and oftentimes exclude that payment. Really makes it easier to qualify. That's a great product that we could use that may give them a little bit more out of their current house if their value's a little bit tight.
So basically, you do a second on their existing home,
Right.
then you can do a first purchase on their new home, exclude all the payments on their existing home, and then once they sell the existing home, it'll pay off the original first, it'll pay off the second, and then they just have a regular mortgage that they got for the house that they bought.
absolutely, we can kind of rebalance. Oftentimes, let's say the rate was a little higher when they got into the property doing the bridge. We can kind of rebalance. Maybe it's a couple months out. Or to leverage, we can even sometimes give them like a 90% first or an 85% first.
And maybe the rate's lower on their first where they don't really want to touch it, but they realize that it's maybe a 2, 3, 4 month loan where if they pay another $2,000 over 4 months, they're getting the home they want. Because right now we're seeing buyers saying they're only seeing one property every quarter that they want to buy. Inventory's picking up, but you might not find something for even 6 months. You have kind of a niche area where there's not a lot of inventory. So when it pops up, you don't want to lose it, and think you have that mindset where you have to sell. Because it might not pop up till 2026. You just don't know.
You also mentioned that you can add a short-term, not occupying co-borrower. What does that mean?
Yeah, so most people don't want to co-sign for mortgages because they don't want to be stuck on a loan. If it's a parent or a brother, they're going to say, well, I want to buy, or I don't want to have this debt obligation. Most of the time, if they know they can be paid off quickly, that they're okay with it. And we would give kind of an exit strategy. So let's just say somebody wants to qualify and they have to maybe do a second mortgage, a bridge loan doesn't work. Maybe their parent, let's say, don't want to qualify, so they can debt to income ratio on the new property. But the parent says, I don't want to be stuck on this loan. So we say, listen, we actually will pre-approve them for the exit once their home sells to then refinance that parent off, that non-occupying co-borrower. So maybe that dad or mom or brother is only on the loan for 3 to 6 months. Most of the time, if we have a lot of confidence from the loan side of things, they're going to be okay with that because it's so short-lived. Where they know they're not stuck as a non-occupying co-borrower, obligated for that mortgage for an endless amount of time. So
got it. So this is just a new loan on the house they're buying, and another party will be a kind of a co-borrower but non-occupying. And then once you sell the existing home, then they get stripped off of that original loan, and they're no longer obligated for that.
That's correct. Exactly. So we have that parent as an example.
qualified to maybe use their dual income. Then once they sell the property that they're moving from, we pay down that loan. Then we do a refinance, take off, that parent. So we actually pays them off. It's a great way to, get the property you want. This all kind of falls back to the fundamentals of the application. The great thing about me is I can see all of these options at once. Say, hey, here's option 1, here's option 2. What are your thoughts? And usually there's that one that jumps out. They say, this is fantastic. We didn't know this existed. I hear it all the time. But they say, we can't buy, we have to sell this. We take a look at it. And they're like, and they're happy in that moment, right? Because they can get what they want. So.
All right. So I assume, look, before I go out as an agent and start looking, obviously we got to get them pre-qualified. This is probably a little more extensive than a normal pre-qual. How long does it usually take for someone to get pre-qualified for one of these programs?
It's a great question.
We're pretty fast. It obviously depends on the type of client. One, if they're self-employed, if they change jobs, if they have multiple properties. I would say, to kind of give a summary or an average, I would say 2 or 3 days, as long as we get documents quickly. Obviously, if we get things over time, it's harder to really analyze. What we probably would do also, if somebody really wants to buy, we probably would also get them fully approved, even using these products, because then you have, for the analytics, about a 30% better chance to get an accepted offer versus just being pre-approved. It's kind of like you said, if you have a buyer come in and you have 3 of them, you have to really weigh what's going to close for your seller. And that's what anyone's going to see. So we want to help that seller, help that listing agent say, this is our buyer, because we're so strong and we're so proactive up front. So I would say roughly 3 days if you're really buttoned up. And then I can present all these options to you very quickly, find that perfect path for you to make it happen.
Awesome. James, this has been great. This is great info. Thanks for coming on and sharing it today. So look, if you're out there and you're ready to buy a house, but you think you need to sell your house first, please talk to myself, talk to James. There is a way to navigate it to make you a stronger buyer. We're here. We're ready to help. James, thank you so much for spending some time today.
Thanks, David. Look forward to talking to you guys. Make it a great day.
Awesome. Thanks, everyone.